In a shocking and historic move, the U.S. government has issued grand jury subpoenas to the Federal Reserve and its chair, Jerome Powell. This is not just a routine legal action. It's an unprecedented escalation in the ongoing battle between the Trump administration and America's central bank. The very institution that has long stood as a pillar of economic stability now finds itself at the center of a political firestorm, with its independence under direct threat. Officially, the subpoenas are tied to two issues: Powell's recent testimony before Congress, and a costly renovation project at the Federal Reserve's headquarters. But these explanations have left many unconvinced, fueling speculation about the true motivations behind this aggressive legal maneuver. Critics argue that the timing of these subpoenas is far from coincidental. They point out that the move comes just as tensions between the White House and the Fed have reached a boiling point, raising questions about whether this is a genuine investigation or a calculated act of political pressure. The timing is crucial. The subpoenas landed just days after the Fed made a series of interest rate decisions that directly contradicted the administration's wishes, intensifying the standoff. The Fed's recent moves to keep rates steady, despite mounting political pressure to cut them, have ignited a confrontation that is now playing out in the public eye. The White House has made no secret of its frustration, and this latest action signals a willingness to challenge the central bank's authority head-on. This isn't just political drama. It's a direct assault on the core principle of central bank independence. For decades, the Fed has operated free from political interference, a safeguard designed to protect the economy from short-term political interests. Now that tradition is being tested like never before. Jerome Powell has responded with defiance, making it clear that the Federal Reserve's mission is to serve the American public, not the president or any political party. He has vowed to uphold the institution's independence, even as the pressure mounts. The world is watching closely. Global markets have already begun to react to the uncertainty, with investors and foreign governments questioning the stability of the U.S. financial system. The threat to the Fed's independence has sent shockwaves far beyond Washington. As the drama unfolds, the stability of the U.S. economy and its reputation as a global financial leader hangs in the balance. The outcome of this confrontation could reshape not only America's central bank, but the world's trust in the U.S. economic system for years to come. The Federal Reserve, or Fed, is America's economic guardian, managing the money supply and setting interest rates to keep inflation low and employment high. Its independence is by design, shielding it from political cycles and election year pressures. If politicians could dictate Fed policy, they might push for short-term booms at the cost of long-term damage. The Fed's governors serve long terms to make tough, data-driven decisions, not political ones. When the Fed raises rates, it cools the economy. When it lowers them, it stimulates growth. Any threat to this independence shakes the foundation of trust in the U.S. dollar. If markets sense the Fed is taking orders from the White House, confidence and economic stability can vanish. The Fed's credibility is the bedrock of the American economy, now under serious threat. Markets reacted instantly to the Fed crisis, with a wave of anxiety sweeping through trading floors around the world. The news sent shockwaves across global financial centers, as investors scrambled to reassess their positions and brace for what might come next. The U.S. dollar tumbled, ending a long winning streak as investors fled uncertainty. For months, the dollar had been seen as a pillar of strength, but now, its sudden decline caught many off guard. The greenback's fall was swift and dramatic, reflecting deep concerns about the stability of U.S. monetary policy. The dollar index dropped sharply, signaling a global loss of faith in the American currency. This index, which tracks the dollar against a basket of major currencies, saw one of its steepest declines in recent years, underscoring just how quickly sentiment can shift in the face of political and economic turmoil. Meanwhile, the euro and Swiss franc surged as investors sought safer ground. The euro, often overshadowed by the dollar, suddenly became a preferred choice for those looking to shield their assets. The Swiss franc, with its long-standing reputation for stability, also saw significant gains, making U.S. goods more expensive abroad and shifting the balance in global trade. The Swiss franc in particular rallied, its reputation as a safe haven now eclipsing the dollar's. Investors poured into Swiss assets, driving the currency to multi-year highs. This shift highlighted a growing skepticism about the U.S. as the world's financial anchor, and a renewed confidence in Europe's ability to weather storms. U.S. stock markets also fell, with the Dow and S&P 500 both dropping as fears of instability grew. The sell-off was broad, affecting nearly every sector, as investors worried about the ripple effects of a weakened dollar and the potential for further political interference in economic policy. Investors are sending a clear message: political interference in the Fed is a red flag. The independence of central banks is seen as crucial for economic stability, and any threat to that independence can quickly erode confidence, not just in the dollar, but in the broader U.S. financial system. The combination of a falling dollar and stock market turmoil highlights the risk of undermining central bank independence. When trust in monetary authorities wavers, markets can become volatile, and the consequences can ripple across the globe, affecting everything from trade to investment flows. The world is rethinking the dollar's role as the ultimate safe asset. As global investors look for alternatives, the balance of financial power may be shifting, with Europe's currencies stepping into the spotlight and challenging the dollar's long-held dominance. In times of crisis, investors rush to safe haven currencies, those backed by stable, independent governments. The Swiss franc is the gold standard here, thanks to Switzerland's neutrality and strong central bank. When the Fed's independence was threatened, money poured into francs and euros, signaling a loss of faith in the dollar. Historically, the dollar was the world's safe haven, but that status is now in question. If the world believes U.S. monetary policy is at the president's whim, the dollar loses its premium. Confidence, not just numbers, drives a currency's value. The attack on the Fed's independence is eroding that confidence, prompting a global search for safer alternatives. The dollar's safe haven crown is slipping. As trust in the dollar faltered, gold soared, jumping 2.4% to a record high. Gold is the ultimate safe haven, immune to political meddling. Its value endures when faith in paper money fades. Investors flock to gold when they fear inflation or currency debasement, knowing its supply is limited. The surge in gold prices is a clear vote of no confidence in the Fed's independence. Even U.S. government bonds, usually safe, saw yields rise as investors demanded more for the risk of future inflation. The bond market's jitters only fueled the rush into gold. In uncertain times, gold's timeless appeal shines brightest. The Justice Department's move drew swift condemnation from across the political and economic spectrum. All living former Fed chairs and top officials issued a rare joint warning. Undermining the Fed's independence risks higher inflation and instability. Leading economists echoed these fears, warning that political control over monetary policy would make the dollar less attractive globally. Politicians from both parties spoke out. Democrats called it an abuse of power, while some Republicans broke ranks to defend the Fed. These unified voices amplify market concerns and highlight the gravity of the threat. Their message, protecting the Fed's independence, is essential for economic stability. The stakes are clear to experts and lawmakers alike. The world is watching how America responds. History warns us, political interference in the Fed leads to disaster. In the 1960s and 70s, presidents pressured the Fed to keep rates low, fueling runaway inflation and economic chaos. The result was stagflation, soaring prices and high unemployment. The dollar's value collapsed, and America's economic credibility was shattered. Only a fiercely independent Fed under Paul Volcker restored stability, raising rates despite political backlash. The painful lesson: central bank independence isn't a luxury, it's a necessity. Economists remember this era as a cautionary tale. Today's crisis risks repeating those costly mistakes. This isn't just political theater, it hits your wallet. If the Fed loses independence, inflation expectations rise, making everything from groceries to gas more expensive. Purchasing power erodes, hurting retirees and low-wage workers the most. Higher borrowing costs follow mortgages, car loans, and credit cards all get pricier. A weaker dollar means imports cost more, driving up everyday expenses. Economic uncertainty slows job growth and business investment. The Fed's credibility protects your savings and financial stability. Undermining it puts everyone's future at risk. At the heart of this crisis is trust, the invisible glue that holds the entire global financial system together. Trust is what allows nations to trade, investors to lend, and economies to grow. Without it, the gears of international finance grind to a halt, and uncertainty spreads like wildfire. In times of turmoil, people and governments look for stability, and that stability has long been anchored by the US dollar. The US dollar's dominance is not just a matter of tradition, it's built on the Federal Reserve's independence and the world's enduring faith in America's ability to manage its economy responsibly. For decades, the dollar has been the currency of choice for global trade, investment, and reserves, giving the United States unique advantages and influence. But this trust is fragile. Undermining it, through political interference, economic mismanagement, or loss of credibility, threatens the dollar's role as the world's reserve currency. If investors and governments begin to doubt America's stewardship, the consequences could ripple across continents. If confidence in the dollar erodes, other currencies, like the euro or China's yuan, could rise as alternatives. These currencies are already being considered by some nations and institutions looking to diversify their reserves and reduce dependence on the dollar. The global financial landscape could shift, with new centers of power emerging. Such a shift wouldn't happen overnight, but its impact would be profound. The United States could face higher borrowing costs, as investors demand more to offset increased risk. American influence in global affairs could wane, and the cost of living could rise as the dollar weakens. The events of 2026 are shaping up to be a critical test for American institutions. Decisions made now will echo for years, determining whether the U.S. can maintain its leadership or if a new era of financial uncertainty will begin. Experts and politicians understand what's at stake: the nation's economic future, its global standing, and the prosperity of millions. They are working behind the scenes, debating policies and strategies to restore confidence and stability. The world is watching closely, waiting to see if America can rise to the challenge and restore trust in its central bank. Every decision, every statement, is scrutinized by markets and governments worldwide. The challenge ahead is clear: reaffirming the Fed's independence and America's commitment to sound economic management. Only by doing so can the United States secure the future of the world's money and preserve its place at the center of the global financial system.